Good day, sir. We are the Group 9, and before we start, I would like to introduce myself and my co-members. I'm Rose Simbol, together with Angel Abong, Janfol Arce, and Jenny Rose Ronquillo.
Our topic is all about capital asset pricing model. So what is capital asset pricing model? It's a model used to calculate an asset's theoretically suitable needed rate of return in order to make decisions about adding assets to a well-diversified portfolio. The model considers the asset sensitivity to non-diversifiable risk, also known as a systematic risk or market risk, which is frequently represented in the financial sector by the quantity beta, as well as the market expected return and the expected return of a notional risk-free assets. And the first assumption is that there is financial market full of smart, well-informed buyers and sellers. Premise defines wealthy investors who prefer more to less. Furthermore, in modern financial theory, hypothetically investors want a premium in the form of higher projected returns for the risk they assume. Also, they focus on the equilibrium relationship between the risk and expected return on risky assets built on Markowitz portfolio theory. Each investor is assumed to diversify his or her portfolio according to the Markowitz model. So, why is CAPM is important? In the finance industry, the CAPM formula is commonly utilized as CAPM computes the cost of equity. It is critical in determining the weighted average cost of a capital, or WACC is widely used in financial modeling. It can be used to calculate the net present value of an investment's future cash flows, as well as its enterprise value and equity value. Um, let's proceed to CAPM assumptions. All investors use the same information to generate an efficient frontier, have the same one period time, horizon, can borrow or lending money. At the risk-free rate of return, no transaction costs, no personal income, income taxes, no inflation, no single investors can affect the price of stock capital markets. Are in equilibrium. Isa sa mga mahalaga na nagpapalagay ng CAPM ay ang mga namumuhunan ay may libreng access sa lahat ng magagamit na impormasyon ng walang bayad. Ipagpapalagay na ang ilang namumuhunan lamang ang may access sa espesyal na information na hindi madaling makuha ng lahat, which is not readily available to all, then the markets will not be regarded as efficient. Next is borrowing lending possibilities. Borrowing and lending possibilities is risk-free assets, means that an investor borrows money at a risk-free rate in order to invest some other risky asset. Uh, ang rate ng return na inaalok 0% risk ang bawat asset na namumuhunan ay nagdadala ng ilang antas ng pagte-take risk mo sa isang investment. Gaano man kaliit, kaya ang walang risk rate ay isang bagay ng isang theoretical na konsepto. Sa pagsasagawa, ito ay tinuturing na rate ng interest na binabayaran sa panandaliang utang ng gobyerno. And use the same information to generate an efficient frontier, have the same one period time horizon, can borrow or lend money at the risk-free rate of return. Nasabi ko din kanina to, and no transaction cost, no personal income taxes, no inflation, no single investors can affect the price of a stock, capital markets are in equilibrium. So, the next is risk-free lending. Risk-free lending are derivatives of dividends-paying assets like cryptocurrencies, bank accounts, equities, or bonds. They are 0 percentage point loan loans in which the counterpart receives the dividends from the underlying assets. We define system that returns fractions of each loan in increments programmatically um, ibig sabihin nagbigay ng mga microeconomic models na nagpapakita kung paano mas mausay ang mga tao sa paggamit ng mga derivatives kaysa sa cash para sa settlement kapag sila ay may iba't ibang kagustuhan in different time references. At bumuo ng isang transfer protocol at patunayan na walang partido ang maaaring maging involvement abang sinusunod ang protocol. The last one is borrowing possibilities. Investors no longer restricted to own wealth interests paid on borrowed money. Higher returns sound to cover expense. Assume borrowing at RF risk will increase as the amount of borrowing increases. Financial leverage.
The new efficient set. Risk-free investing and borrowing creates a new set of expected return risk possibilities. So dito, yung risk-free investing and borrowing, so yun, nagka-create yun ng panibagong expectations sa mga tao about sa possibilities ng risk and return. Addition of risk-free assets result in a change in the efficient set from an arc to a straight line tangent to the visible set without the riskless asset. So dito, may pagbabago from an arc to a straight line kasi magiging konti na lang yung risk na isusugal nila if they invest or borrow. Chosen portfolio depends on investors' risk-return preferences. So dito, yung napili mong ang portfolio, nakadepende yung sa investors kung ano yung preferences niya about sa risk and return. The next one is portfolio choice. The more conservative the investor, the more is placed in risk-free lending and the less borrowing. So, the more na conservative daw yung investor mo, mas marami mapupunta sa yung risk-free sa lending kaysa naman sa borrowing. The more aggressive the investor, the less is placed in risk-free lending and the more borrowing. So, dito naman is baligtad siya. The more na aggressive yung investor mo, less siya sa lending naman, yung risk-free niya, and marami naman sa may borrowing. So, sabi dito, most aggressive investor would use leverage to invest more portfolio. So, sabi dito, karamihan sa mga aggressive na investors, gumagamit sila ng leverages, means mga cash, mga ganun, para mag-invest pa sa maraming portfolio. So, the next one is market portfolio. Most important application of the CAPM. All investors hold the same optimal portfolio of risky assets. So, lahat daw na investor is, pareho silang may hawak. Lahat sila is may hawak ng optimal portfolio para sa risky assets. So, yung optimal portfolio na yon, highest point siya ng tangency between RF and the efficient frontier. So, yung lahat ng portfolio na yon is nakapaloob siya dun sa optimal risky portfolio. So, yun yung market portfolio. Lahat ng risky assets is nandoon. The next one is characteristic of the market portfolio. All risky assets must be in portfolio, so it is completely diversified. So, sabi dito is lahat daw ng risky assets dapat nasa iisang portfolio. So, madali na lang ito ma-diversified. Ibig sabihin nun, mahihiwalay, ganyan. Naka-include dito is yung only systematic risk. All securities included in proportion to their market value. So, lahat ng lahat ng securities is naka-include din, pati yung proportion dun sa kanila sa market value nila. Unobservable but proxied by S&P 500. So, nakapaloob dito is yung financial and real assets nila. So, the next one is capital market line. Dito naman, pinapakita dito yung mga risk niya if mag invest ka sa isang company. Line from RF to L, ayun yung capital market line. So, yung X, yung risk premium, tas yung Y naman, is, ayun yung risk. So, the next one is the separation theorem. Investors use their preferences to determine their optimal portfolio. So, dito, yung investors, ginagamit yung kanilang kagustuhan upang matukoy yung optimal portfolio. So, separation theorem. The investment decision, which risky portfolio, is to hold is separate from the financing decision. So, yung investment decision na yun, which is risky na, sobrang risky hawakan, sineseparate nila yun sa financing decision na ginagawa nila. So, allocation between risk-free assets and risky portfolio separate from the choice of risky portfolio. So, dito naman is, paghihiwalay-hiwalayin mo yung risk-free asset, yung risky portfolio, tapos hiwalayin mo pa yung kung anong gusto mong risky na portfolio. So, the next one is separation theorem. So, sinasabi dito all investors. So, sinasabi dito na yung lahat na investors na yun is nag-invest sa same portfolio. Dito is ina-attain nila, yung mga investor na yun, ina-attain nila yung straight line from RF to T hanggang L by either sa pagpapahiram or pagpapautang sa rate ng RF. Pero nakadepende yun sa preferences nila, kung ano ba yung gusto nila, ganyan. Risky portfolios are not tailored to each individual stage. So, yung risky portfolios na yun, hindi yun inaangkop sa bawat isang sa taste ng bawat isa.
Capital market line. Slope of the CML is the market price of the risk of a patient portfolio or the equilibrium price of risk in the market. Relationship between risk and the expected return of the portfolio. Dito is nire-represent niya yung portfolio that optimally combine risk and return, and it's a theoretical concept that represents all the portfolio that optimally combine the risk-free rate of return and the market portfolio of risky asset. Capital market line. Dito sa PowerPoint namin is makikita nyo yung equation for CML, where is the slope interpretation of the CMLs that represent the return and available to an investor with a no risk or additional return that can be expected reward for holding the investment risk. This is new as the risk premium. Security market line. Dito naman po is nilalarawan ng security market line ang trade-off sa pagitan ng panganib o inaasahang pagbabalik para sa mga individual na security. Hawak ng lahat ng namumuhunan ang portpolyong merkado o paano makakatulong ang isang individual. Makakatulong ang CML sa ating individual dahil dito malalaman niya kung namumuhunan ba siya o nalulugi na sa isang merkado. Security market line. Expected return equals return A times probability A plus return B times probability B. Expected return is just one of the many potential returns since the investment market is highly volatile. You can calculate expected return as the weighted average outcome since the account for the investment history performance. Security market line. Beta equals 11.0 implies as risky as the market. Security A and B are more risky than the market beta 1.0. Security is less risky than the market beta is 1.0. Security market line. So dito yung beta is mini-measure na yung systematic risk. The SML can be helped to determine whether the investment product should offer a variable expected return compared to its level of risk. The capital asset pricing model is the model that subscribes the relationship between expected return, risk, or investment is a security. At pinapakita dito that the expected return on a security is equal to the risk-free return plus risk premium, which is based on the beta of the security. The security market line can help to determine whether an investment product should offer the variable expected return compared to its level of risk. Ang rates ng Treasury bill ay ginagamit upang tansyahin yung risk of free. Bagamat ang security market line ay maaaring maging isang mahalagang tool para sa pagsusuri at it should not be used as solution as the expected return of an investment over the risk-free rate of return is not only things to consider when choosing an investment.
Good morning, sir. My name is John Polas and I will report beta estimate and arbitrage pricing theory. So, beta is a measure of volatility or risk for an individual stock, and it tells how correlated the stock with the market average. And it gives investors a better idea of how volatile the stock will when compared to the market. So, beta is used by the investors because nakakatulong siya to determine how much risk is yung willing nilang i-take to achieve the return for taking the risk. And sa beta, a stock beta that is greater than 1 tend to be riskier or sensitive, but it provide the potential for higher returns. And low beta stock has a less risk or less sensitive and it has a lower return. So, para siyang relationship between risk and return. The higher the risk is the higher the return and vice versa. So, how accurate are beta estimates? Beta change with company situation. It is not stationary over time and it means that it is always moving or changing rather than staying. And estimating a future beta, sa pag-estimate naman ng future beta, pwedeng maiba yung future beta kumpara sa historical beta. Because yung past price movement, hindi siya ganun kaganda gamitin pang-estimate sa future beta. And it is only approximated with the stock market index and to the return on all common stocks. It means na close lang siya sa actual pero hindi siya masyadong ganun ka-accurate. Second one is arbitrage pricing theory. This theory was developed by the economist Stephen Ross in 1976. It is alternative to capital asset pricing model. And based siya sa assumption na sa isang well-functioning na security market, dapat walang nag-exist na arbitrage opportunity o yung chance na magbenta ka ng isang financial instrument na sobra yung presyo kumpara dun sa normal na presyo. Sa arbitrage pricing theory po, iniiwasan po kasi natin na may benta yung financial instrument like securities na wala sa tamang presyo or price. And pag-compute ng expected return sa isang security, nakabase po tayo sa movements sa mga microeconomic factors. So, ibig sabihin, the market return is determined by a number of different factors. Microeconomic factors like supply and demand, GDP, and inflation. The expected return risk relationship for the APP or arbitrage pricing theory can be described as ER equals risk premium for factor 1 plus risk premium for factor 2 and plus risk premium for factor n. The problem with arbitrage pricing theory is to implement this model, we need the factors that account for the differences among security returns and it rely on unobservable expectation, same as the capital asset pricing model. Yun po yung problem sa APP.